Record. All right, we're all going to get started here in a second. Thanks for tuning in. We'll get going here in a second. Just reaching 2 o'clock. Welcome.
Yeah, probably give it a minute, let a bunch more people join the call.
Yeah,
in the next minute or so, and we'll get moving.
Yep, absolutely. If you're just tuning in, I think your mics are going to be, or your everything's going to be automatically muted. Feel free to keep your camera on or camera off, whatever is easier for you. You know, if you're comfortable keeping your camera on, yeah, that's great. I think you're automatically going to be muted for now. We're going to get everyone unmuted kind of in the as we kind of progress, because we're going to leave plenty of time for questions and answers and things like that. So stay muted kind of at the, you know, for the moment. If you want, you know, feel free to chat. You can chat through the chat portal. How's everyone doing today?
Yeah, so
go ahead.
I figure we'll take a look at the chat like throughout the conversation and then maybe address the questions towards the end. I think that's a better way to go.
Yeah, also, if you don't mind, in the chat, maybe just introduce yourself as well as what area you're currently in and anything else that you wish to kind of share with everybody. Maybe something related to how many loans you do, the name of your company, things like that. But maybe at least, you know, what area of the country you're in and what area, if you're lending or maybe just getting started lending, what area you're lending in. So cool. Well, as some more participants join up, I'll make sure to look over and let them in. We'll just kind of do a real quick intro. So this is our free monthly event. You know, if you're new to the Hard Money Mastermind, you know, we do the Hard Money you know, inside the Hard Money Mastermind group. Obviously, there's been a lot of good chatter over the last few months, and you know, obviously, Chris and myself are happy to kind of help out, answer any questions that we can. And we try to do some, you know, some free group events, interviews, things like that with other industry experts, you know, that you could potentially use as a resource kind of throughout the country. We also have our coaching group, which that meets up the second Wednesday every month. So if you're a member of that, we'll see you next Wednesday at 2 p.m. So, and the coaching group's a little bit, not that we don't go through advanced topics, and not that this isn't an advanced topic, but we go through stuff a little bit more advanced related to raising private money and operating your business and finding deals and back-end servicing stuff and things like that. But we're trying to do some more kind of interview style Zooms like this, because I think there's a lot of value with bringing on industry experts. And obviously we're only kind of going to bring on people that, you know, Chris and I have worked with in the past. And this is an interesting topic, because a lot of hard money lenders and private lenders, I don't think, take the doc prep and the title review as seriously as they probably should. And Chris and I have always discussed this more kind of on the business side and less on the legal side, because we're not attorneys, and we utilize vendors and attorneys like Harris. So we actually have 2 different attorneys that does our doc prep in our title review, and Harris is one of them. He's been working with us for over 7 years now. But again, you know, we typically more concentrate on the business side, and you know, let the attorneys deal with the legal side of stuff. But the title review and the title work and the title insurance and the loan docs, I can't emphasize, make sure you have a professional that's doing that. And we're going to go through some of this here in a second of why.
Yeah, for sure. I definitely agree that the chatter, this is kind of what made us think of asking Harris to come on. I'm going to introduce him in just a second here. It's because the conversations about this very topic in the mastermind, I was a little surprised actually that some people were maybe doing loan docs themselves, maybe possibly even worse than that, having the title company do their note and mortgage and stuff like that for them. And we jumped in and said, like, we've had attorneys preparing our loan documents since day one, 13 years ago. And you definitely should, whether you're doing one loan or 5 loans or 500 loans, right? And so we're going to jump into that too. And definitely title review too. There aren't too many areas of real estate after we've been in this business for a long time where I'm not very competent. I feel pretty competent in a lot of areas of real estate and lending and finance, not with title stuff. I mean, after the fact, things that can happen, but in terms of policies and endorsements and everything else, like, I'm pretty good at this stuff and I don't really know what I'm looking at. And so some people on the call might agree. So yeah, let's get moving. Harris Dainoff with Ledgewood in Philadelphia. How are you? Thanks for being with us.
Yeah, my pleasure. Thanks for having me.
Yeah, definitely appreciate you taking the time. And like Jason said, we've been working with Harris for about 7 years now, and we've done hundreds of closings. I don't know how many it's been, but it's been great. And also over time, you've hooked up with a couple of the people in our mastermind group, and you've been doing some docs and title review stuff with them as well. It's been great. Definitely appreciate it. So, all right. I guess let's start with some basic stuff before we get into more specific questions.
Sure.
Why is it so important for these documents to be prepared by an attorney and same with title review?
Yeah. So, like anything, when you have an attorney that has the experience to know what documents are appropriate for what situation, whether you have a construction reserve in a document or, in a loan, or you have a fully amortized principal and interest loan, or a balloon payment loan, or a interest only loan. I mean, there are different circumstances that come up with each business deal that an attorney is going to know the appropriate documentation to manage that. Whether you have an individual borrower or an LLC borrower, and you need to account for authorizing resolutions to make sure that the appropriate parties are signing on behalf of the entity, so you don't have an issue there. That's all the stuff that we have, an expertise in, and can quickly, efficiently, and appropriately document your loan, so that, and you guys know, Jason and Chris, based on experience, that because we've done so many deals together, you can send us a loan information sheet and have documents that are correct for that loan turned around in a business day, sometimes less, depending on the circumstances. And you're not spinning your wheels. You're not relying on, certainly not relying on the title company to do something like that. I wouldn't recommend it, but, not doing it yourself and taking away from the underwriting piece. You just have someone there that knows how to appropriately document the loan. And then for us, the other thing that we do for you guys is interfacing with the title company through the closing process, reviewing title, making sure that the policy that you are going to receive after closing is correct, with the appropriate endorsements, the appropriate coverage, that the settlement sheet is right, that the closing procedures are right, and that they're not funding a loan before they have all the documents that they need. Because, that's your money, right? Until you have until the title company and the borrower have satisfied all your closing requirements, that's lender's money. And we need to be very careful and make sure that a title company is not releasing that money before they have the proper authorizations to do so. And that's where we play into all of that. So, I think that's why it's important to have an attorney available and working with you and for you through that process.
Yeah, exactly. And we'll kind of add to that as well. If you just tuned in, you can either, if you're in Zoom, you can obviously either do this kind of on speaker view or gallery view. Obviously, gallery view, you'll see everybody. Speaker view, which is on the top right-hand corner, it'll just be the speaker. And kind of any questions as we're talking, going through, just so you don't forget them, just chat them in the chat, and we'll try to go, if they're relevant at that time, we'll go through them. And if they're not, we're going to unmute everybody at the end, so there's plenty of time for questions. And we're talking about loan docs kind of in the first segment, then we're going to jump into title review and title insurance and stuff like that, lender's title insurance in a second. So let's kind of go through some of the relevant and important loan docs in a loan document package. And we've done trainings on what loan docs are in there, kind of on a business side, but we can kind of go through them. We don't have to spend a ton of time for them, but related to obviously a mortgage or deed of trust and a promissory note, can we I don't know, just go through kind of some of these on a broad level?
Yes, certainly.
Also, one thing, Harris, just to throw into, if any, so unfortunately, some of the points that we're going to be driving home for people today comes from mistakes people have made in the past, or right. So if anything comes to mind that would be a relevant story to that particular point, feel free to bring that up too.
Yeah, absolutely.
All right, so I guess you want to just kind of run through a few of these. And we're both going off the top of our heads, and obviously there's different there's different documents per different situations, but in general, the most standard loan package is typically we're lending money to a business entity, typically an LLC, where the members of the entity are guaranteeing the loan, right? And there's some sort of construction component. So maybe we can just kind of run through some of these together and kind of what they represent. And maybe, let's say like promissory note, for instance, we can start with.
Sure. So the promissory note at its most basic level is the borrower's promise to pay, right? That's going to set out the amount of money that they owe on the loan, the terms for repayment, whether it's interest only, whether it's principal and interest. Did I lose you?
No, go ahead. Yeah.
No, we're good.
All right. So that is, that's the note. It's not very long. It's going to have your interest rate, your maturity date, your principal and interest, and that is the document that provides a promise to pay. Sorry, Jason,
yeah.
Give me 1 second. There's one thing I got to do for connection that I have. 1 second, please.
Yeah, no problem. All right, cool. And then we'll go ahead.
Yeah, we can definitely roll through some of the loan documents themselves and what should be in there. I think that people who have done loan docs on their own probably have 25% of the documents that go into a professionally done package like what we have. I think a lot of people will throw together or have a title company throw together a note and a mortgage and they think it's done. But there's actually a bunch of other stuff that would be included in a professional loan package, and we'll get to some of that as well.
Yeah, so let's go through the mortgage or a deed of trust, and what's the difference?
Sure. So that is just purely based on jurisdiction. You have a mortgage states that use mortgages as the security interest or the security instrument, or you have a deed of trust state where they use deeds of trust as a security instrument. Those documents secure the obligation of the borrower to pay back the loan, right? So if you default on the note or if you default on any of the other loan documents, you have a security instrument recorded with the county documenting your interest in the property that you can then foreclose on, right? So when you talk about foreclosing on mortgage, you're foreclosing on that security instrument that is recorded at the county. And that document will have some additional obligations of the borrower, to maintain the property, to pay taxes, to insure the property, make sure that they don't commit any waste or do anything in violation of laws. That is the document that sets those obligations out. So you have your promise to pay with the note. You have the security instrument securing that obligation with the mortgage or the deed of trust. In states where there are deeds of trust, you often have to designate a trustee. And that trustee is the entity or the individual that is going to work through the foreclosure process. It's just an additional layer that some jurisdictions have. For instance, in Pennsylvania, we have a mortgage. New Jersey, we have mortgages. I believe in Maryland and Virginia, they're deed of trust states, right? So, that's purely going to be a function of where you are in the country and what the process has been set out for that. Similar to, the foreclosure process. Some states provide for non-judicial foreclosure, and which means that you don't have to go through the formal court process to foreclose. Others require judicial closure. So some of those are more state-specific issues.
And one of the things, then we'll go on to the next doc, but one of the things to really keep in mind is if you don't have the right deed of trust or the right mortgage, that keep in mind that goes on record, right? The mortgage and the deed of trust, some of your loan package goes on record, in the land record, that your assignment of rents and leases and stuff like that, which we can talk about. But if it's not the right document, things getting kicked back. It's not getting put on record. And again, the title company, obviously, who's insuring the transaction, the title insurance, can help with that. But it's just something to think about. Like, it's got to be the right way, and you don't want to have any issues. And I think, like Chris mentioned earlier, too many hard money lenders who just want to do this stuff themselves, or they don't have somebody who's an expert that knows this stuff. They're only doing like a promissory note and a mortgage, because to them that's the only thing that they need, when really there's a lot more documents. All right, so let's go through kind of what's next on the docket, Chris, you think, for 11?
Let's do the guarantee agreement and confess judgment, and how that can, like, what the guarantee means, and how the confess judgment, what that means too, and how it can vary on jurisdiction as well.
Sure. So using the guarantee first. So when you have an LLC borrower, which there's a number of reasons, if I were a borrower's attorney, and I am in some instances when I represent borrowers on loans, they are likely, if they're sophisticated, they are going to want to purchase the property, acquire the property through an entity, through an LLC that protects them from liability, right? That entity is designed to separate the assets of the investment from any other assets that individual has. So if they default, or more importantly, if there's an accident or slip and fall or something like that, the liability is the LLC's liability, not the individual's. So the way that, from a lender's perspective, you said, that's all well and good. I understand you are going to set your loan up with an LLC borrower because you want to protect yourself from liability. However, if that entity defaults, our recourse is against the property and against nothing else. So if the property is not worth what it used to be, if there was a casualty and we can't collect full value, we have no other recourse. Or that's just going to be too complicated. We want to go after you. We want recourse against the individual who is managing or responsible for that LLC. So that's what Jason was alluding to at the beginning. We often require the members of that LLC to personally guarantee the loan. That means if the borrower defaults, if they can't make their debt service payments, or they haven't insured the property, or they haven't paid the taxes, not only can we foreclose on the property, but if we didn't want to do that, we can seek a monetary judgment against the guarantor. So it's like, maybe the property is not performing, but your guarantor's got, millions of dollars personally, then you can pursue that individual for a monetary judgment and get recourse that way. So it's very important, especially when you have LLC or entity borrowers that have no other asset other than the property that is the subject of the loan, that you get a personal guarantee from the members that are responsible for that LLC or managing that LLC, to guarantee the loan, so that you have an alternative avenue of recourse if there's a default. Confession of judgment, not unique solely to Pennsylvania, although there aren't many states that allow for it. But confession of, the right to confess judgment in Pennsylvania basically means that you are able to accelerate the process for foreclosing or obtaining a monetary judgment against the borrower, or oftentimes against guarantors as well. That there is an accelerated time frame so that foreclosure doesn't take a year. If you're doing it the right way, you can confess judgment and get a judgment in foreclosure or a monetary judgment against the borrower or the guarantor much quicker. I mean, the way the language reads, it implies that you can do all of this without notice and without any due process. That's not really how it works. There are statutory notice requirements, but they're quicker. It is a method for, in a clear-cut case where there is a default and there really is no defense. You haven't paid. You were obligated to pay a certain amount of money. That money has not been paid. Maturity has passed in some cases, or even you just haven't paid your monthly debt service. The lender can foreclose quicker than they would if they had to go through a protracted, litigation, complaint, and response process.
Fortunately, I'm pretty sure that in all of these 6 states where we lend, we can do confessed judgments in every one of them. Some of the documentation language might have to be changed. For example, there's another important reason to have attorneys for this stuff. We learned early on that in order to have a confessed judgment in the note in Virginia, we had to have all this big, bold language right at the top of the note on page 1 in different jurisdictions. So just another important point. And should we jump in with Mike's question now, Jay, or should we wait till a little bit later?
Go ahead. I was going to answer
right on topic.
Yeah, go ahead.
Okay. So Mike asked, how effective is the personal guarantee in practice? And a little complicated to answer that because many, many different things can happen. But there are oftentimes, so it works different in different states. In a few of the jurisdictions where we lend, it's 2 separate processes, legal processes, to start a foreclosure on a piece of property or to record a judgment against someone who owes you money. In Pennsylvania and New Jersey, I like the way they do it because it's in one. The first thing you do is you file a judgment and then you foreclose on that judgment. So it kind of wraps it into one process, which make things a little more smooth and less costly, to be honest. So in collecting on a judgment, a lot of different things could happen. Now, you could get a judgment on quickly, which would attach to other assets in the same jurisdiction if the timing's good and the person has other things they might be trying to move. And in those cases, you can catch something real quick and they have to make good on your debt in order to do whatever the other business that they are doing. There's also things that could happen that, if someone has this piece of property and they really don't have any other assets, you're not going to get a whole lot from, like you can't get blood from a stone, or like whatever that term is. If somebody doesn't have money or properties or other assets, there's not much you can get with them. It could happen that you get a judgment on record and then it just hangs out for a few years. I got one this week. We took a deficiency judgment, like say somebody owes you 200 grand, you get 150K from the sale and you record a deficiency. And then 3-4 years later, it popped up and the guy called me and said, hey, turns out I have a judgment. Can we settle this thing? And I'm like, sure, let's talk it out. So it does pop up in different ways. It's a very useful tool. It's not foolproof. You're not always going to get it. Oh, something else that's pretty interesting in certain jurisdictions. You can have a filed judgment that you can use to levy, I don't know if that's the right term, but to take the funds from a borrower's bank account. If they owe you money and you know where their accounts are, which you probably do because you've got their bank statements and stuff at underwriting time, and you send a pretty simple writ to their legal department and they debit their accounts and send it to you, which is pretty gangster, to be honest. Like we don't use that just kind of willy-nilly. If somebody is behind a few months in payments, like it would have to be a pretty serious situation for us to pull that out, but we have. And it has been very useful. So kind of a long answer, but it's kind of a complicated subject, collecting on judgments. So hopefully that helped you out, Mike.
Yeah, and those judgments, what you just said, Chris, those judgments, they stay, right? Once they are filed judgments in that jurisdiction, they attach to properties. And it doesn't mean that you'll have an easy time forcing a sale or collecting, but at some point, like you said, a borrower is going to sell a property. They're going to move. They're going to want to sell something. And in the course of that sale, a title company is going to run a search, find that judgment, and that's when they're going to come back to you. And they're going to say, I still have this $60,000 judgment. It's interfering with my ability to sell this other property. Can we take care of it? And so you may not get paid immediately, but it is, as you said, a useful tool.
And I think it's important to note that whoever's doing your loan docs and your title review and stuff like that, you're more of the business side, they're more of the legal side, and it's good to kind of explain to them kind of what you're looking for, have them recommend things to you, and vice versa. And like, there's certainly situations that we don't have personal guarantees on because we feel it might not be necessary, right? I'll give you an example. We lend to self-directed IRAs, right? So if the borrower's a self-directed IRA, they can't guarantee the loan anyways. It's a non-recourse loan. And in our minds, we'd obviously do a reduced LTV, but we'd say, let's do a 50 LTV instead of a 65 LTV. And to us, that extra percent equity is more important to us than a guarantee that we may or may not collect on. And also, there's a difference between what legally you have the right to collect on and what you want to actually go after. You know, it could get expensive to do a foreclosure and do a judgment. Sometimes judgments are more expensive than foreclosures because, you know, it's not just the filing of the judgment, it's the collection on the judgment. So Chris and I, as the business owners, have to make a decision on, hey, is this guy a deadbeat? Like, is it even worth going after this dude for something? You know, who are the guarantors? So, you know, as a company principal, you got to figure out, okay, these are the borrowers, these are the guarantors, and things like that. You know, and sometimes the entity, you know, could be the borrower and guaranteeing. Sometimes you might want another entity that they have that might have additional assets to guarantee the loan. Maybe you want them to personally guarantee the loan. Maybe you want somebody else involved to personally guarantee the loan if they have some sort of co-borrower or gap funder that you can find to be put on the hook. Related to what if personal assets are in an LLC, it depends. I mean, Mike, depends on the LLC. Like if it's the LLC that's the borrower, you know, that you're lending against, if that's the case, then, you know, that's no problem because the LLC was the borrower and guaranteeing the loan. If it's a different LLC, potentially it might be hard to pierce. But again, depending on who's doing kind of that legal work for you, you know, could see if they can go collection on it. But you know, it's one of those things that the purpose of this is to be able to tie up legally whatever you can get your hands on. I think that's important. And your loan documents are obviously protecting yourself and your investors, and then you can kind of choose what to act on in the future. When you know, hopefully a default never happens, but then if it does happen, let's jump into a few other docs, and then I want to spend time obviously on title review because I think that's more overlooked than anything.
Yeah, let's so Jay, how about we talk about some of the recorded instruments, the docs that get recorded and why?
Yeah,
like if we're talking about, do you want to go that direction?
Yeah, well, let's maybe real quick, Harris, if you can go through the construction agreement and corporate resolution stuff, because I think those are
absolutely. And before I forget, just not to, and then we'll move on. But you were talking about the importance of, you know, the documents and having an attorney. One of the things that is important is the language in the documents have to be correct in the remedies that they provide on a default. And you have to think of it this way. And I think you guys will agree based on your experience. By and large, the litigation and, you know, judicial process of foreclosure is borrower friendly, right? The court system does not want to see borrowers losing their property without having due process. So if you don't have documents that are correct and legally sufficient to allow you to foreclose or confess judgment, and you don't go through that process correctly with the guide of an attorney, you'll get tripped up, and it just takes a lot longer to get through that process. They are not shy about opening and striking judgments that were not appropriately obtained, because I think all other things being equal, borrower gets the benefit of the doubt oftentimes through the judicial process. So
that's a good point.
I did want to make that point. Right. So the construction agreement, you know, for rehab loans that aren't just straight refinances, we will add a construction loan agreement that sets out the terms under which the rehabilitation will occur, how long they have to do it, how funds that may be escrowed for that construction work get released from time to time, and the conditions on that release, oftentimes those conditions being an inspection of the property, which you should be getting paid in advance for, collecting for in advance for your construction inspections. It'll have, you know, evidence of payment of invoices or invoices to be paid with that construction draw, lien waivers or conditional lien waivers for the contractors that are doing the work. And that's also important to title, but so that, you know, there's no claim out there that a contractor has done work, has not been paid, and now they're going to file a lien against the property. That in some jurisdictions may, you know, not often, but may prime a mortgage or complicate a foreclosure of a mortgage in any case. And so that's what the construction loan agreement will cover. All of the conditions for completing construction, completing the rehabilitation, releasing funds that were escrowed at closing in one or a series of draws, so that at the end of this, if you've got a $100,000 loan and 30,000 is being held back for construction, because that's really where your underwriting says, once it's rehabbed, I can support $100,000 of loan to value. But before then, it's only 70,000. So you want to be sure that as you're releasing that $30,000 escrow, they are improving the property, which is then improving your collateral. So that's the purpose of that document. And then in terms of corporate resolutions, it sort of goes back to what we were talking about in the beginning. When you have LLCs or corporate entities as borrowers, it is extremely important that you have somebody that's reviewing corporate documents, that knows what they're looking for, to make sure that the appropriate parties are authorizing the loan, and that those parties and then the authorized parties are signing on behalf of the loan, or on behalf of the borrower for the loan, to the loan document. So the clearest example is you have a 4-member LLC. You got to look at the operating agreement, right? And the operating agreement is going to say either a majority is required to authorize, X, Y, and Z, including, signing notes and mortgages, getting loans secured by the property, or unanimous. We always, to the extent that all 4 members in that situation are available, I always err on the side of, even if the operating agreement says majority, I always err on the side of getting a unanimous resolution from all of the members, so that nobody can have, there can be no mistake, and nobody's going to come out and allege that this loan was granted and secured by property owned by the LLC. They didn't authorize it and they were entitled to. If you have all of the members signing that resolution authorizing the loan, you're avoiding that situation. So even if the operating agreement says majority, best practice is to get unanimous, unless it's absolutely impossible. Someone's not available, they're overseas, it's clear as day that it says majority, and it's not required, then okay. But if you've got 4 members, and then they'll sign resolutions, all 4 of them authorizing the loan, authorizing Jason to sign on behalf of the LLC, and then in the loan agreement or in the loan documents, you're going to have XYZ LLC signed on behalf of, signed by Jason as the authorized member on behalf of that entity. And that's what the authorizing resolution does. It sets that out for everybody, goes in the corporate records, goes in the lender's file, so that if there's ever an allegation that, the documents were signed inappropriately, or someone didn't authorize them and they needed to, and that becomes a title issue too. That's on the title company to review that stuff as well. And we can get into that, and maybe that's a good segue for title. But that's, that is what the purpose of that document.
That's probably one of the most important things. And this comes
and
up
overlooked, and probably overlooked as well.
Yeah,
because if you aren't careful, people very well might try to borrow against a company that they're not supposed to be signing for that loan or buying that piece of property. Like, unfortunately, shady stuff like that does happen in the real estate investing business. So something really important to look out for. And I just want to throw out one comment on the construction agreement that I can speak about from, in practice. This thing comes up recently, and one of the most important terms in that agreement is the time frame during which they have to complete the construction. Mm-hmm. Here's why. One of the routine checks that we do at HMB is we're always keeping an eye, each of the loan originators and us, on the construction balance left in that account. Here's why. Say you have, typically in our agreement, it's 180 days. Is that right? Usually 180 days for most of our construction jobs. So they have to finish the job in that time frame. I'm sorry, I lost you.
And then they have a period of time to exit the loan after that, right? So you want to get it done before the term of the loan expires.
Right, exactly. And here's what can happen, guys. So even if somebody's on time with payments, you might notice that they haven't taken a draw in several months. Maybe that $50,000 construction balance has been there since last summer. and they're making their payments, so it might not totally be on your radar, but that job is probably stalled. And that's not part of the deal. They have to improve the collateral that you lent against, because otherwise it's going the opposite way. So that does happen, guys. Seriously, like people will have 5 different jobs going on at the same time, and you might have financed one of them, and they might not be working on that job. So you can have a non-monetary default situation where they have not completed the job during that 180 days, even though they're making the payment on time, right? So that's something, a realistic situation that happens a few times a year for sure.
And also, real quick, going back to this corporate resolution, which I believe is probably one of the most important things, and it comes up the most, weekly, is you have multiple members, and they say, "Oh, well, I've got power of attorney," or, this member doesn't sign. Well, first off, if they're on the entity, for the most part, we're always making them sign at least that resolution. They don't have to sign on behalf of the entity, right? You can have a managing member that signs all the business docs, but all of them have some sort of company certification or typically a corporate resolution in their operating agreement, but that's a standard corporate resolution. And keep in mind, most real estate investors are pretty fast and loose, right? So things are changing, they're adding members, whatever it is, right? And you don't know if it's the most up-to-date agreement. That's just the one you're provided, right? So to ensure that it is, you get that, it's a deal-specific resolution that's stating, for XYZ property, we understand that we're encumbering this property, we're getting a loan, and this borrower, this member is signing. So I think that's important, because there's no way to contest that, because all of those people are signing on that. And we've had issues where this backfires. I mean, keep in mind, let's say you create an entity with a friend, one of your borrowers creates an entity with a friend 2 years ago, right? And they do a loan with you, and then maybe the deal starts going sideways. And then all of a sudden, one of the members is like, "Hey, we do construction, and then we give the money to the entity, and then maybe they go separate ways, and then all of a sudden they're fighting about it, and then they're not a part of the entity anymore, and then they go to it could be a mess, right? It just makes the most sense for all of them to sign that, and you're going to run into problems where someone's like, "Oh, well, this person's not really a member. Why do they have to be present?" And it's because, yes, they're still involved in the transaction, and you want them to be. I mean, I'm not stating that there's no exceptions to the rule on that, but try to get every single member to sign, not just on that resolution, but also personally guarantee the loan. And another quick tip: you can't do a power of attorney on a guarantee, because it's not going to hold up if you try to file a judgment against them, right? Like if me and Chris, if Chris has a power of attorney over me and he signs a personal guarantee on my behalf, chances are they probably couldn't come after me personally.
Yeah, very shaky. Very shaky legally.
Deal. All right, so let's go through some title review and title insurance real quick. Like, I guess, Harris, let's just start off with what title insurance covers, and maybe a little bit of, a real quick difference between lender title insurance and owner title insurance.
Sure. So title insurance is at its most basic level, the title company is insuring, as the lender, is insuring your usually first lien mortgage position on the property. So they are insuring your mortgage that when recorded, it is the prime lien on the property. There can be exceptions to that. If you're a known second mortgage holder, then obviously you're going to be subordinate. But that's their objective. And similarly, with an owner's policy, they are insuring the deed for the property that you own it, right? So that when you get the deed and that deed is recorded, that the person that sold the property to you and was the grantor on that deed was the owner of it and has transferred that title to you, and you now own it. And so to do that, they have to do research, right? They have to research the records to make sure that the person who is claiming to be the owner and selling and the grantor on the deed does in fact own it and is able to sell it. That for a mortgage, that the borrower or mortgagor owns the property and has the ability to mortgage and lien the property to its lender. And then they have to research the records and make sure there aren't any what we call interceding liens, that there aren't any other liens ahead of you that could impact your first lien priority, right? So there aren't any existing liens that aren't getting paid off. There aren't any contractors that have filed liens that haven't been paid. And they oftentimes get an affidavit, or they always get an affidavit from the borrower saying that they haven't done any work recently that has been unpaid and could become a lien, because those contractors have lien priority even if they haven't filed the lien yet. And that's something that I think you guys will see from time to time. And it's very important that your borrowers make that representation to their title company, that they have not done work. No work has been done that has been yet unpaid that could turn into a lien that then primes your mortgage, even if it hasn't been recorded yet, which is, a mechanics lien law is a very nuanced but important piece of all of this. So that's what, that's what title insurance is. It's insuring your lien priority, or in an owner's context, it's insuring title, as the owner of the property.
Okay, and moving a little bit further into that, could you talk a little bit about the typical exceptions? First of all, what exceptions to title insurance policies are, and the main ones that pop up that we might try to get rid of in a lot of our common deals?
Yeah, I mean, so as just going back to what I had said before, they're going to do the research, they're going to research the records, and if they're doing to mitigate their own risk as an insurance company, which is, the goal of any insurance company is to mitigate risk, they will accept out from the policy, meaning you don't have coverage for anything that they find of record. Things that we don't normally care about, utility easements, as long as they don't impact, they're not running under a building or doing anything that could impact our use of the property. But I mean, you're going to see that all the time, right? You're going to see a telephone company has a utility easement, cable companies, water companies, sewer companies. Occasionally there'll be access easements with adjoining properties, that I get to use your parking lot, you get to use my parking lot, or so that I'm not landlocked, I can drive through your parking lot. And in those cases, you should have an attorney reviewing those documents of record. There's nothing the title company is going to do about it. Title company is going to accept that and say it's of record unless you can get something that removes it from title. I'm accepting it from my policy, so that if you have an issue down the line, that's on you.
What type of issue could they have for that particular case? Just,
with like access. Well,
yeah,
so,
just a quick example.
You're now, because you've provided access rights to an adjoining property owner, if you wanted to develop the property in the future and you wanted to build out or expand on a property and build an addition, you can't build it through the access area, right? You've given access to your adjoining property owner to allow them through the property in that scenario, and you can't build over it. So that's something that, a borrower or a lender, depending on what they're interested in, what their use or potential use or value to the property might be, if you see it as a development potential, or if you're, let's say you're getting a mortgage on unimproved or underimproved property and you see some development potential there, it's important to understand what's encumbering the property that may limit your future development, access agreement being one of them. I can't build through that access agreement unless I go talk to the adjoining parcel owner and get them to, release it. But the title company is not going to ensure that. They're going to say, that's on you. I've given it to you. I've accepted it from my policy. Now you have to have an attorney review it and make sure that you're comfortable with it from a business perspective.
And like Harris said earlier, title insurance company, just like any insurance company, they mitigate risk. They want to give you the absolute worst policy that protects them the most, not you. So, what are some things that maybe and again, things change, right? If you're doing like a bridge loan on a commercial property, a freestanding building, this might differ than a townhouse. But let's just say like a regular single family house in a subdivision. Is there anything that kind of comes to mind that the title company just by default will put it, will put an exception in that you will go back to them and say, hey, listen, we want this out of our policy. If you want to keep it in the owner's title insurance policy, that's fine. But related to us as a lender, title insurance policy, can you please remove it?
Yeah, there's a few things. We often refer to them as general exceptions. They are the blanket exceptions that show up no matter what the record. There could be no documents of record for this property. There are general exceptions that the title company is going to list. Those are negotiable if you ask for them, but you have to know to ask for them, right? So those are things like taxes. Well, if the taxes have been paid, that shouldn't be an exception to the policy. The exception should be limited to taxes that have not yet been paid or not yet due and payable. Another example is the mechanics liens, exactly what I had said before. A title company will try to accept from their policy any potential mechanics liens that may arise resulting from previous work. Well, if you know to have the borrower sign an affidavit confirming that there has been no work, the title company should remove that exception. And then if there is a mechanics lien that pops up, they have to pursue the borrower for that because the borrower fraudulently represented that there was no work when there was. And that created a lien that you now have coverage for. But if you didn't know to ask to remove that general exception, you don't have that coverage. And that's a big one. So like if you just accept the title policy the way they give it without having somebody make these comments or marking it up and sending it back, they will include those general exceptions that are removable with very little work. Another example, survey exceptions in Pennsylvania, which is a good one, which I think you're getting to. In Pennsylvania, for a lender's policy, you do not need a survey to remove the survey exception from the policy. They will give you an endorsement that in effect removes the general survey exception from the lender's policy without a survey. So the general exception reads something like any matters that a true and accurate survey would disclose. And that's anything and everything, right? That's as general as it gets because that's what a title company is going to do if you don't ask them to remove it. You can get an endorsement to remove that without an actual survey, not on an owner's policy, because the difference between, from a title company's perspective, an owner's policy and a lender's policy is they have much less risk. With a lender's policy, they're willing to take more risk with a lender's policy because their risk is less. Because in order for there to be a title claim on a lender's policy, not only is there a title issue, there has to be a default on the loan and a foreclosure, and then the lender pursues a title claim. If there's no default on the loan, the lender's not going to pursue a title claim. Whereas with an owner can pursue a title claim at any time. So, an owner's policy is riskier for a title company, which means that the title company is less flexible on what they're willing to do to modify the title.
Harris, is that survey exception in Pennsylvania commercial stuff too, or just residential?
Yeah.
Yeah, that's good to know because, so here's the thing. The survey isn't as important, obviously. Like, let's say you're lending on a single family house that's in a newer subdivision. Like, chances are you're never gonna have a survey issue. Same with like a townhouse, same with a condo. Obviously, commercial stuff is a little bit more, it's a little bit different. And the reason why these title companies typically won't do a survey exception is they don't know what the survey is going to find out because they don't know what they don't know, right? So that's why typically what happens is we never really order surveys on residential properties. On commercial properties, we do with the title company. I didn't know that about Pennsylvania, but we lend in 6 states, so it differs. But the title company would be like, hey, should we order a survey? Or they'll be like, the borrower doesn't want to pay for a survey. It's like, we don't care if you get a survey as long as we don't have an exception on our policy that's related to the survey. Like, the only reason we're ordering a survey is so the title company can remove any exception that they could possibly give. And on the other side, the title company might say, well, we don't know what's going to pop up. That's why we should get a survey. And if you're doing a $100,000 loan and a survey is going to cost $550 or whatever, a few $100, it's a decent amount for a borrower to pay for that.
One thing, let me jump in with one thing real quick, just to talk to all the members on the call today. So if title insurance and exceptions and stuff like that is confusing to you, don't worry about it. You don't need to be an expert in this. This is why we need attorneys for the legal aspects of the lending business. You do not need to be a black belt in title insurance exceptions. In addition, this is exactly why during these conversations on the mastermind, we've pointed out and been very, emphatic about the point that you shouldn't have title companies or title attorneys doing your loan documents for all this stuff. They work for the title insurer, and they have a conflict. They have a straight conflict when we're talking about a lender's policy. If they are doing title review, which they're not, they're just giving the policy exactly the way the title insurer wants it to the lender, and they're saying, here you go, here's your policy. You want me to do a note and a mortgage for you? Sure, let me charge you some money, no problem. And they will say that, and they will earn those fees, but they're not working for you really. They're working for the title insurer. Okay, so important point.
Yeah. All right, let's let's go over a few quick title insurance stories of why it's important to make sure you have proper title insurance, and we can kind of end with some of that stuff. And then, anyone who has a question, either chat them in or you can raise your hand here shortly. But, I'm sure you can imagine, after us lending on over 3,000 projects locally, like we've had our fair share of run-ins with title companies and title insurance. And I'll tell you times that this stuff can come up, and to make sure that, it's legit. And I mean, this isn't a conversation of making sure you're working with a reputable title company, and more importantly, one of the bigger title insurance companies, Harris or whoever attorney you work with, you can can help to make sure, because there's no name title insurance companies, and who knows if they're even going to be there to pay out a claim in the future. So obviously, the Fidelities and the Old Republics and the Chicagos, the bigger ones of the world, First American, those are the ones that obviously are recommended if to be on paper. And the bigger title companies, the actual title company doing it, the bigger ones obviously work with them. It's the smaller title companies that might not have an account with some of those insurers you gotta be worried about. But there's been a lot of cases where we've got paid out by title insurance companies. I'll give you an example. Depending on what county or jurisdiction that you're in, depending on how quick things can go to record, related to if it's digital or if they still have to go down and record it, there's a lot of cases that these deals move quick. So there's been times where, like, we'll go and we'll lend on a property, the borrower fixes up the property and sells it, and that's before, and we don't even go on record, right? Like, we're not even on record that quick, right? So the deed wasn't on record, and our deed of trust, so the mortgage isn't recorded on record. Now keep in mind, this is on the title company, right? So as long as you have a proper title insurance company with proper title insurance with the proper title company, you're safe. But literally, the loan will get paid, the borrower sells the property, the new title company comes in and says, and just disperses all the funds to them. They don't even realize that they have a mortgage against the house because it wasn't on record, right? And, maybe the recording gets kicked back, or the title company lost it, or whatever. Like, this happens. This is common, right?
More than you would think.
More than you would think. So, like, Chris and I are going through our end of the month reporting and saying, we haven't got a payment from this borrower. We reach out to them and they're like, oh yeah, I sold the property. Or we look on MLS and we realize the property's sold. And obviously they're in default. And what we do is we obviously file for foreclosure right then. And, as soon as you go file for foreclosure, it attaches to the house, right? So typically you're foreclosing on a new happy homeowner who just bought this nice renovated house and they've got their title company coming in. All the title insurers are out there fighting. They pay off our claim, right? So we're going after the title insurance company to pay off the claim, to pay off the property. So, like, we've had lots of different issues with this. And I would say getting the loan on record has always, that's a common one. Trying to get it on record is, as quick as possible. What other title insurance kind of issues we've had? And it's good to make sure you're working with a good title insurance company.
We've definitely had some. I don't know. There can be some fraud that can pop up where title insurance steps in and cleans it up. I mean, those are never fun, but it has happened. People are borrowing against properties they're not supposed to. We've seen that before. I don't know. There's some stuff that can happen and that triggers a title insurance situation or claim.
That goes back to what we were talking about before with the authorizing resolutions. It's definitely on us, as lenders and lenders counsel to review that stuff. But likewise, it's on the title company to review that stuff too, because they are insuring your mortgage, and included with that insurance is insurance that it was properly signed, that it was authorized, and it was recorded. So what Jason was talking about is what we refer to as insuring the gap. There is going to be a gap period between the time that the mortgage is signed and when it's recorded. And the title company is ensuring that gap, which is why they want it to go on record as quickly as possible. But there are times where it gets kicked, or, you know, we close at 4 o'clock on a Friday and the title company's like, I'll wait until Monday. And then it's Tuesday, Wednesday before the mortgage is of record. There's actually risk there for the title company that somebody else can come in and record a mortgage or record something else that intercedes and gets in front of, ahead of, because, you know, because lien priority is always first in time, they get ahead of you. So that's, you know, that's on the title company to ensure the gap, and it's on the title company to ensure that everything was properly signed. But why I say we don't just rely on the title company, because as I'm sure Chris and Jason can attest, title claims are exactly that. They're time consuming, they're costly, they're stressful. You don't get paid the next day if you have a claim, right? That stuff gets drawn out for a really long time. And they're stressful, and it's litigation, and there's all sorts of headaches that go along with it. So it's not so simple as saying, it's okay, I've got insurance, I'll rely on my title insurance. That may be the right answer sometimes, but there's often times where it's not like, oh, I just want to, you know, I'm going to accept my future title claim, because those claims aren't easy to get.
And also keep in mind, this is a little advanced, but keep in mind what an insurance policy does. Insurance policy is only going to pay out the max of what the insurance policy covers. So for instance, if a borrower is buying a property, so let's say you're doing a loan for $100,000 and you have title insurance on it for $100,000. Well, guess what? Let's say that borrower goes into default, they miss payments, you had to step in, maybe cover taxes, and your payoff might be 115. Well, guess what? That title insurance policy is only covering 100. So now obviously you can get a little bit more black belt and, you know, talk to your attorney to see if you can push on this to try to get higher coverage. So there's cases that will request 125% title insurance coverage for that case, because we've had issues like that in the past. You know, and, you know, the borrower's going to have to pay a little bit more for that. If anyone has any questions, let's start with some questions. I have one other question for Harris. It's only going to be a real quick answer, that I'm sure, but there's a few questions in the chat that I'm going to go over as well, but raise your hand if, actually, Chris, how do you raise your hand on this thing again?
Raise hand, I forget.
All right, so if you can figure out how to raise it digitally, raise it digitally. If not, just undo your camera and then put your hand up. We only got about 20 people on here right now, so I can see everybody on my screen, and put your hand up and I'll unmute you. Harris, real quick, just can you talk real quick about the difference between a judicial and a non-judicial foreclosure? We didn't talk about that.
Yeah. I mean, in its simplest term, judicial just means you're going through the court system, right? So you have to go through a formal litigation process to foreclose. That's the typical route, certainly in Pennsylvania, New Jersey, the bulk of the jurisdictions that I work in. But there are jurisdictions that provide for non-judicial foreclosure, which means outside of the court process, you can hold an auction, you can effectively foreclose without having to go through the litigation process to make that happen.
Gotcha. Okay, let's go through some of these real quick. So thanks, Glenn. To raise your hand, just click on the reaction button in Zoom, and then you can raise your hand to that.
Yeah, some of the things are a little bit off topic based on today's call. Maybe we'll just address those in the mastermind if you want to ask those inside of the Hard Money Mastermind platform. We'll try to get to everything that's relevant to this particular topic, though.
Yeah. Well, Phil, real quick on that one, the capital investor doesn't need to sign anything. It's just like, you know, you sell a property to somebody, you're the one signing the deed over to them, and you're the only one signing the loan. You're signing the assignment when you sign that over. I had a good one that I wanted. I had a few good ones. I guess we can go through Jason's. Is increased title insurance coverage something that we have to ask Harris's firm to pursue, or does Harris's firm automatically ask to increase coverage each time? Okay, so here's the thing. You know, remember, you're the business operator. Harris is, for the most part, working on your behalf to protect your interests of what is seen to be best. So I talk to Harris regularly. On stuff. You know, when we started our relationship, and we've been lending for about 15 years, Harris and his paralegals came in about 7 years ago. So they've been doing stuff with us for the past 7 years. But when we started, it was like, this is what our business looks like. This is what we're looking to get set up. And we kind of molded stuff around it. He was like, okay, cool. Well, because they do our stuff in Pennsylvania, New Jersey, and Delaware. It's, well, this is what's different in Pennsylvania compared to Maryland, Virginia, and DC, because that's where our other office is. And this is what you guys should do. I'll give you an example. We used to file UCC ones back in the day, and we realized they're dumb, they're irrelevant, waste of money, waste of time. Discharging them was a pain in the neck. So, but recommended, something we thought to do back. So we kind of have a candid conversation about what we're looking for, and he puts in his recommendations of what he thinks, and then we mold a relationship. Like Harris started this conversation out. I hate that we only can give them a 1-day time frame to do our loan docs, but that's kind of the nature of the business. Things close quick in the residential stuff. The commercial stuff takes, we have a longer time, a lead time, but on the residential stuff, unfortunately, it happens quick, right? So, he has our loan package that is molded to our business and our operation. And, things differ. Like this one's going to be a corporation with 2 guarantors. This one's going to be an LLC with 1 guarantor. This one's going to be an individual name. This one's going to be a trust. And he's got to review the trust documents. So Harris's team or whoever you decide to use, if they need to be able to do this. I know Harris can do this, but we approached Harris on that title insurance thing, and we're like, hey, listen, we got stuck we're stuck in a litigation right now, and we're only going to get our principal back. We're going to have a hard time going after the borrower to get anything more than the title insurance policy is. So Harris kind of came up with me of like, hey, listen, maybe we should make a general rule of thumb that all of our loans we do at 110% or 120% or 125% title insurance. So, he came up with that kind of solution for us, and we're like, yeah, let's do that. And if we have a borrower that pushes back, because keep in mind their policy is going to be 25% higher now, right? So if their title insurance, it was going to be $600, now it's going to be, whatever, $750 for that policy. So there is a cost to do that. And chances are you probably don't even need it. But in our case, out of the 3,000 plus loans, now we've run into a situation that we do need it. So we're like, let's just put that as a general practice. So to answer your question, we have that set up as a default in our loan package. So I'll let Harris answer this question. Can Harris make a templated note and mortgage to use over and over to save costs?
Yeah, that's what we do, right? So, the only, Jason and I have this conversation all the time. The way that this relationship works for everybody is it's on volume. It is, these documents are not negotiated. The fee structure, the timing, all of that, none of that works if you're going to have a borrower that's going to review your package, provide comments, you're going back and forth a few times. It's a take it or leave it set of documents, similar to like I forget the documents that people use for just a straight residential mortgage.
Fannie Mae docs.
Laser Pro or Fannie Mae, right? It's similar to that. And over time, I don't want to say that we've seen everything that you guys have come across, but we've probably encountered 90% of everything. So we've done it before, right? So if we get a loan information sheet and it's, we've got an LLC borrower, 2 guarantors, and cross-collateral property in New Jersey, we've done that, right? And we've saved it in our system that way so that we can pull up that template, change names, change dates, change, loan amounts, interest rates, like whatever needs to be changed loan term. But, most of the document is going to remain the same. And then.
Sorry, I accidentally muted you, Harris. Can you unmute?
At what point? All of it?
No, only like 2 seconds.
Oh, okay.
So you can't mute our guest. Can't mute the guest anymore. That's no good.
So that's how this works, right? We've seen it before. We pull up our document for Pennsylvania or for New Jersey or Delaware or wherever we are working. and plug in the deal terms and ship them out. And that's the way that we're able to do this, do it efficiently from a timing perspective, do it in a way that the cost works for us and for the borrower, for you guys from a business perspective. That's how we do it.
And what is the process like when you take on a new client, a new lender, and you're going to be doing documents for a new state, like taking a doc set and customizing to a new state or jurisdiction? What does that look like?
So as a reminder, we are licensed in Pennsylvania, New Jersey. We're also licensed in New York. But as a whole, as a practice, we have done deals, whether it's for hard money lenders or for traditional lenders, in almost every state of the country. We do a lot of work in Florida. We do a lot of work in Texas. Do a lot of work in the Midwest and California. So we have those templates. We have that experience. We're not licensed in those states, but not having a license doesn't restrict us from being able to do work there. If there's anything that we're not comfortable with, obviously we engage local counsel. If anyone were to come to me from a state outside of where we are licensed, which we've done with you guys before in Oklahoma and Virginia and Colorado, my recommendation is let's use my template. We'll use state-specific provisions that we've developed over time based on our experience in that state. And then I always recommend that one time you take that loan document set to a local attorney, have them review it, make sure that the state-specific provisions that we've incorporated are kosher for that jurisdiction, that they work, that they're enforceable, that they capture everything and all the peculiarities of specific remedies that may be utilized in those jurisdictions. Once that local attorney has blessed it that one time, then we can take it from there. Then we have the process set up to use that template, prepare the documents, interface with the title company, get the appropriate endorsements. So if I'm taking on a new client that's operating outside of a jurisdiction where I'm licensed, the recommendation always is at the outset, when we're developing that template, let's take it to a local attorney, make sure that they're comfortable with it as well, so that we're not going to have enforceability issues down the line. And once that local attorney's blessed it, then we have the platform set up to do these on volume. Because a lot of times what I think people find is you may have a local attorney, but they're not set up. They haven't done this work like we have for the last 7 years. So they fumble over it, right? Or they say like, there's no way I can close a loan for that number, right? For that fee. It's going to be significantly more. And that's because they just don't have experience doing these things on volume like we have.
Yeah. And also, Harris's company or whoever does I'm using Harris as the example, obviously, because he was kind enough to share an hour plus with us. But the point is, if you decide Harris, if Harris isn't the best fit for you in this particular case, you got to find someone that's going to replicate exactly what his service is. Because it's not negotiable. You have to have somebody to do this. But him and his office are working directly with the title company on our behalf, right? They're prepping the loan package. They're telling them what the requirements are. They're setting everything up for the title company and going back and forth. Yes, we're approving the HUD and things like that, but they're providing closing instructions to them. We didn't really talk about closing instructions, and that's okay. Chris and I've talked about it in other videos, but closing instructions or maybe Harris mentioned that at the beginning. It indicates exactly what's expected from the title company of what they need to provide us. They need to get the borrower to sign all the docs. They need to do this, they need to do that, and they're signing that, and they're putting their name on that, stating that we will not disperse funds until all of this is in place. The insurance is paid in full. All the documents are signed. Things like that. But they're doing all that stuff. So, and also it's not as easy as and I know Harris kind of mentioned that it's hey, we start with a template, we work off that. So when we started, I remember because it's hard to find, a law firm that can do a turnover so quickly, that can get these deals done quick enough. And we had an issue at the beginning with our original legal counsel. And we were like, listen, why don't we build out some sort of system or software to work with you to try to get these deals done quicker and to get the docs done quicker. And there was hundreds, not like 10, hundreds of variations of loan docs, hundreds, because sometimes you have 2 guarantors, sometimes you have 4 guarantors, sometimes you have one person signing as a managing member, but they're not personally guaranteeing. You can lend money to an LLC, multiple member LLC, single member LLC, multiple corporations, some sort of trust, a self-directed IRA. Lots of times.
And then all of what you said in every different state.
Yeah, exactly. In every different state and different jurisdiction in the state. And then also sometimes there's multiple entities. It could be ABC LLC and NBC LLC. Could be the borrower. Could be a LLC and a personal name. Who's signing this? Who's guaranteeing this? A lot of deals we do have cross collateral in them. The cross collateral could be in different states, right? So you might have to prep a mortgage, then you might have to prep a deed of trust. Like, I'm telling you that these things get significantly more complicated than one might think. It's not as simple as, let me just get a boilerplate note and mortgage and put it on record. It doesn't work like that. It might, one of the properties might have a construction agreement, one might not. Like, it's very, very complicated. Now, I will tell you that we have some sort of loan info form that we provide to Harris and their team so they can go through that. And he has that template as well. But and then it describes kind of what's going on. But there's a lot of back and forth, because what's in your head of what your expectation is could be different when all of a sudden you have to map this doc set of exactly how you want it. And keep in mind, you're raising private capital for some of these deals, right? It might not just be your own money. So, you want that attorney to make sure they're the one that's representing, this properly, especially if you're raising capital behind these. I'll let Harris, answer that question, just kind of range of prices for docs.
Well, yeah, and also just to jump in on that real quick, what Harris was saying before, the difference between a lot of these residential investment deals and larger commercial stuff is that there's only a certain amount that your borrowers, your savvy borrowers, your pro real estate investors are willing to pay for any fee, including legal doc prep fee, right? And when you're talking about a larger commercial transaction where you have 2 weeks and a $10,000 budget and a lot of back and forth between a few lawyers, that's why it needs to be efficient. Like Harris was saying before, you need to be set up with that machine so that you can hit the price point that's required in residential investing.
Yeah. So what was the question, Jason, is what our fee is generally?
Range of prices.
Yeah, I mean, it changes. Look, for a cookie cutter deal without much complexity, we are preparing the documents, providing a markup to title and interfacing with them to close. Our standard flat rate fee is $750. When it gets more complicated, and if there's support in that with within the underwriting that we think that the borrower can support, a little bit of a higher fee, and there's complexity, cross collateral, more complicated title, or a borrower that you can't pin down and changes their date, 5 different times on their closing date, and we have to go back and revise the loan documents, not just because of the date, but because of the per diem and some of the calculations. We'll bump that up to $1,000 or $1,250, depending on what it is. And then with the commercial deals, it's totally different. Commercial deals are a different animal. The loan amounts are usually more. There may be occasionally comments, but in any event, title's a little bit more complicated. There's a survey review that needs to go into that. So, that's the range.
Yeah. And obviously the borrower pays it, right?
Right.
So, and I'll tell you from experience that, we've done thousands of deals at that, and the borrowers don't budge typically on that. It just seems like that's because it's expected. And seeing and knowing, tons and tons of lenders throughout the country, I'll tell you that I've seen stuff on the absolute low side of $250 or $300 where someone's just putting together a private lender just putting together some crappy note themselves, right? And then there's a lot of big name lenders that do hundreds and hundreds of projects a year that charge $1,500 flat fee. The Templeview Capitals of the world, or the big one, the Lima ones of the world, the bigger ones like that, they charge sometimes their fees, more as well. So, but I will tell you that we don't get pushback on that at pretty much at all. That's typically where it comes in at, and they're expecting it. So, it's not a big deal, and you need it, and your capital investors need it, right? Like, you cannot do docs on behalf of your capital investors or money. Like, it's not cool. Like, you need someone protecting them. Like, you want to get sued by a capital investor when a deal starts going bad, use that, do the docs on their behalf. Like, that doesn't work. So it's not even something to think about. So I want to see if I don't know if there's any other questions. If there's any last minute questions, let me know. I'm going to mention one more thing related to, Mike asked this question, or I think Mike was going back and forth with Zach on this, related to Pearson, I guess Pearson LLC, or going after. Again, I'm not an attorney. I don't fully know this, but I think if it's a single member entity, you could potentially try to pierce that to go after assets through their personal guarantee. But if it's a multi-member entity, I think it's a little bit more challenging to do that. I don't know, Harris, if you know the answer to that or not.
You're saying
to go after a judgment. So let's say, like, let's say they do have a guarantee. Let's say, let's say the borrower has is guaranteeing something, and they own they own assets in a completely separate LLC that has nothing to do with this transaction, but they have assets in it. Can you pierce it?
It gets complicated in terms of piercing a different entity. It speaks to how segregated the entity really is, right? Was it really a special purpose entity, or do they commingle operating accounts? And do they commingle, they use the same office space? Do they use, do they file taxes, the same? Do they commingle accounts? When all of that is the same and they really do everything exactly the same and just use like two different names, you have the ability to pierce and consolidate, so that if one has defaulted, you can consolidate the other's assets to collect. If they're separate and the borrower is doing things the right way, where they really aren't, where they are operating as two different entities, it gets harder, right? Because that's what the statute is intended to provide, is to provide that liability and the ability to silo assets of one entity into another. It's a pro-business mechanism, right?
Yeah, I mean, and ideally you want to get as many people as possible to guarantee the loan, many entities as possible, what you can. I mean, but it goes back and forth, if the borrower pushes back. I mean, I will tell you, the majority of the states that we lend in are marital states. So for instance, let's say I'm married, let's say your borrower is married, but the spouse isn't signing. You can't go after, their marital home. You can't go after their primary residence if he or she is also on there, if they didn't sign. And I know some old school private lenders that always and a lot of banks do this as well. They always make spouses sign as well to go after marital assets. The general rule of thumb is use that guarantee as an added bonus, emergency use only. If you don't think you're going to be able to collect enough money on the real estate alone, don't do the deal. It's just that simple, because it's very rare that we collect on a guarantee, and we use it kind of as like a last minute, just to try to collect. And usually all the time when we do foreclosure default or a deal goes in default, we usually are able to collect pretty much the majority of everything through the foreclosure. But that doesn't mean that other late fees or additional default interest we can't go after. So then we'll potentially do a judgment to try to recapture the majority of it. But usually the real estate's the most important part. Let me just leave it at that. Like,
no doubt about that.
Like, we're collateral-based lenders.
Yeah. So no, I appreciate some of the good questions from people, and also just nice comments as well. So it's been a really informative and amazing call. Somebody said, related to some of the title exception stuff, they've been in the business 20 years, in real estate for 20 years, and had no idea that you could ask the title company for anything. So I think we definitely provided some value here today. Definitely appreciate, Harris, you taking the time for coming on. Yeah, and also, could you provide your contact information? We'll post it as well, but in case anybody wants to reach out to you about your services.
Yeah, office number is 215-790-2386. And email is first initial last name. So HDAINOFF@ledgewood.com. It's LEDGEWOOD.com.
Nice.
Very good stuff. Thanks
Nice.
again. This will be posted in the mastermind as well. And we will see all premium members next week for our team training, Wednesday, 2 p.m. Eastern.
Awesome.